Welcome to the Riskwiser Zone. I'm your host, Louis. Today, we're diving into the world of fintech and exploring the latest developments that could redefine the revenue streams of one of the industry's key players, Robinhood Markets. As we navigate the complex landscape of stocks and finance, it's essential to stay informed and adapt to the ever-changing market dynamics. Recently, Robinhood made headlines with its announcement to expand into the investment banking space by becoming a direct underwriter for initial public offerings, or IPOs. This move has the potential to open up new revenue streams for the company, allowing it to tap into the lucrative world of equity underwriting. By doing so, Robinhood aims to provide its customers with early access to IPO stocks at their listing price, rather than the inflated secondary market prices that have traditionally been reserved for institutional and high-net-worth investors. This development is a significant power move by Robinhood, as it seeks to challenge the dominance of traditional Wall Street investment banks. The company's decision to become a direct syndicate partner in IPOs could potentially disrupt the status quo, providing a more democratized access to these investment opportunities for everyday users. However, it's crucial to acknowledge that this expansion also comes with its own set of challenges and risks, including the need to build trust with corporate issuers, navigate complex regulatory requirements, and manage the volatility of investment banking fees. As we consider the implications of Robinhood's move into equity underwriting, it's essential to maintain a balanced perspective. On one hand, this development could be a game changer for the company, providing a new and potentially lucrative revenue stream that could further fuel its growth. On the other hand, investors should be aware of the potential risks and challenges associated with this expansion, including the uncertainty surrounding the company's ability to execute on its plans and the potential impact on its valuation. With Robinhood's stock currently trading at 49 times forward earnings, it's clear that investors are banking on strong growth ahead. However, as we've seen time and time again in the world of stocks and finance, past performance is not always a guarantee of future success. As we continue to monitor the developments surrounding Robinhood's expansion into investment banking, it's crucial to approach this story with a critical and nuanced perspective, considering both the potential opportunities and risks that lie ahead. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating tale of investment and industry. Recently, a fund backed by renowned investor Madhusudan Kela made a significant move, purchasing a stake in Steamhouse India for a substantial Rs 40 crore. This transaction is particularly noteworthy as Steamhouse India is on the cusp of its initial public offering (IPO). The company, which operates a centralized steam supply model for industrial customers, has already filed its updated draft red herring prospectus with SEBI. What's interesting about Steamhouse India is its innovative approach to serving industries such as chemicals, textiles, and pharmaceuticals by supplying steam directly to factories through dedicated pipeline infrastructure. This model not only aims to reduce costs for clients, but also promotes efficiency and sustainability. The use of IoT and AI-enabled systems across its operations underscores the company's commitment to modernizing industrial practices. The investment by Singularity Large Value Fund, the third, and Singularity Equity Fund, the first, along with Nivishai Sambhav Fund, signals confidence in Steamhouse India's potential for growth. With plans to expand its services into areas like nitrogen compression, waste-to-energy solutions, and aviation logistics, the company is poised to make a significant impact on the industrial landscape. As we consider the implications of this investment and the impending IPO, it's essential to recognize the broader trends in the market. Investors are increasingly looking towards companies that offer unique value propositions and have a clear path for expansion. Steamhouse India's centralized steam supply model and its foray into sustainable energy solutions align well with these investor preferences. In conclusion, The story of Steamhouse India and its pre-IPO placement serves as a reminder of the dynamic nature of the investment landscape. As companies continue to innovate and grow, investors are presented with opportunities to be part of compelling narratives. Welcome back to the Riskwiser Zone. Today, we've been discussing the latest developments in the tech industry, and now it's time to dive into the world of AI and chipmakers. We've got a fascinating story about Nvidia, a company that's been at the forefront of the AI revolution, but seems to be losing its momentum. According to recent reports, Nvidia is no longer the favorite AI play for investors, with other companies like SpaceX, Advanced Micro Devices, and Intel gaining traction. Now, let's take a closer look at Nvidia's stock performance. Despite being out of favor with the markets, brokerages continue to raise their target prices for Nvidia stock. In fact, Baird analyst Tristan Gera has set a street-high target price of $500, which would put the company's market capitalization at over $10 trillion. However, some investors are worried about the sustainability of AI capex and growing competition in the AI chip market from players like Amazon and Alphabet. It's essential to consider both sides of the story. On one hand, Nvidia has expanded its target market by another $200 billion with central processing units, CPUs, and expects $20 billion in revenue from CPUs this year alone. The company is also exploring new areas like sovereign AI and physical AI, which could drive growth over the next few years. On the other hand, the AI capex frenzy may slow down, and competition from other players could impact Nvidia's earnings. As we weigh the pros and cons, it's crucial to remember that investing in the tech industry is always a high-risk, high-reward game. While some analysts believe Nvidia's valuations are reasonable, others think the company's growth may be overestimated. Ultimately, it's up to each individual investor to do their research and make informed decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.